Today is Sunday, January 17th, and this is a market recap for the activities on Friday and an outlook for this upcoming week. We witnessed a different story on Friday. Instead of gapping higher, the market opened gapping lower in terms of the Dow Jones, S&P 500, and the Russell 2000. And of course, it didn't take long before the Nasdaq joined the party to the downside. The market, of course, was reacting to the announcement of the Joe Biden's incoming administration's stimulus plan. And perhaps the market did not like the extra inflationary pressure from a new round of stimulus. And of course, the market did not appreciate the comments from Joe Biden regarding increasing taxes. In this video, we will evaluate the Biden's economic plan and its implications on the economy and the stock market in specific. The market also reacted negatively on Friday to a slew of macroeconomics news in the morning, specifically retail sales. So we will go over all the macro data that we got on Friday's morning. And of course, we have other important stories to cover, such as new developments in the EV wars. But for now, let's start with reviewing how the indices closed on Friday. And here we go. The Dow Industrial Average closing in the red, down 177.26 points, or a decline of 0.57%. The Nasdaq leading the declines of the day, down 114.14 points, or a decline of 0.87%. S&P 500 closing in the red, down 27.29 points, or a decline of 0.72%. And here are the sector's performances for Friday. Leading the pack, capturing the gold medal, real estate, the second place, and the silver medal, utilities. Meanwhile, the third place and the bronze goes to healthcare. The laggards of the day, led by energy, basic materials, and financials. Let's contrast that with the weekly picture in the sector's performances, and we see that energy finished up at number one by far in capturing the gold medal. Real estate for the second place and the silver. Meanwhile, healthcare once again captures the bronze in the third place. The laggards for the week, led by basic materials, communication services, and consumer defensives. Big week for the dollar, bad week for metals. And moving on to review the futures market performance on Friday. Here we go, starting with crude. We saw big declines here for crude oil across the board because Friday was a big upside day for the US dollar, finally breaking above the resistance level of 90.5. Right away, you saw crude oil prices diving lower. Likewise, we saw declines in metal prices, gold, silver, platinum, copper, palladium, all trading in the red. And of course, when the US dollar rallies, you see commodities suffering, as you can see with grains, soybean oil, soybeans, corn. The bulk of grains futures traded in the red, with exception to wheat, trading almost 1% in the green. Meanwhile, we saw meats futures rallying higher. We saw gains for live and feeder cattle, in addition to lean hogs. And let's conclude with the picture from softs. Declines across the board, led by lumber, sugar, and OJ. Meanwhile, coffee closing with slight gains. Meanwhile, the biggest winner here, cocoa futures, up almost 1.5% for the session. Moving on to the big casino, the options market. Let's see how the table performed on Friday. Leading the pack at number one, Apple, with over 1.7 million contracts traded on Friday. About 72% of those were calls. Tesla at number two, with over 1.2 million contracts. About 54% of those were calls. Coming up number three, NIO. We saw an uptick of activities just slightly in NIO, with about 840,000 contracts. About 69% of those were calls. And a similar story for Palantir. We saw a subdued set of activities the last few days for Palantir, but we saw slight bounce in the volume for Palantir options on Friday. That was good enough to help the name, closing the green amidst a challenging day for the stock market overall. And I am leaving the list a little longer here because I want you to pay attention to AMC and the uptick of volume that we have witnessed on Friday. We know that there is a conspiracy online of mobs of traders attempting to create gamma and short squeezes in the market. They have done that successfully with GameStop stock. And the question is, where is the next target for the short squeeze attempt? Is it going to be AMC? Certainly a name with a high short float. We saw an uptick of call options buying on Friday. Perhaps they are setting the stage here for an attempt to trigger short covering in AMC. So keep an eye on this name and how it performs this upcoming week. Moving on to the unusual activities we saw in the options market on Friday. And let's start with the trade for the IWM, the small caps index. In this case, they're making a bearish bet buying the 194 puts, expiration date January 29th, with expectation that the IWM will decline over 8% by then, and they are paying about $1.15 to enter the trade, bringing the total to over $1.5 million. And what about this trade for Bank of America, the ticker BAC? We saw a slew of banks' earnings on Friday for JP Morgan, Wells Fargo, and Citibank. The absent party from the earnings reports on Friday was Bank of America. Bank of America reporting on Tuesday instead. And usually when we see all of these banks getting punished for whatever reason, they decline together. And then next week, when Bank of America reports its own earnings, we see the name rallying higher. This has been a pattern for a few seasons now, where we see banks declining when they report on Friday, and then individual names reporting the week after react more positively to their own earnings. This phenomenon also happens with Goldman Sachs, Morgan Stanley's earnings, Home Depot and Lowe's earnings. And here is a trader betting to cash in on a rebound for Bank of America shares when they report next week. And the trader is buying 37.5 calls, expiration date February 5th, with expectation that the name would rally over 13.5%, and they are paying about 12 cents to enter the trade. Here is another notable one for Tesla, and in this case, they're making a bullish bet for next week, buying the 910 calls, expiration date January 22nd, with expectation that Tesla will rebound over 10% by then, and they are paying about $5 a pop to enter this trade, bringing the total to over $5 million. Here is another interesting one for the triple Qs, proxy of the Nasdaq. And they are buying the 342 calls. It is a bullish bet this time around, and perhaps the trader is assuming that the rally in yields have reached a short-term top for now, and we will see a retreat in yields, and in turn that would help the high-growth sector in the Nasdaq. And in this case, the trade is for the expiration date of February 2nd, with expectation that the Qs would rally over 10% by then, and they are paying about 95 cents to enter the trade, bringing the total to about $1 million. And by the way, I get this question repeatedly. How do you know if a certain trade is a buy or a sell? Again, this is a trade. For every buy, there is a sell. You can look at this trade as somebody making a bullish bet for the Qs to rally. You could also look at it as somebody selling those calls, expecting the Qs to decline. So it is a trade. For every buyer, there is a seller. Usually, however, buys trigger sells, specifically for these unusual activities type of trades. Here is another interesting one for the ticker VHC, and this is for Vernix Holding Corporation, and they are trying to do a gamma squeeze on this one. They were successful on Friday. Stock rallied over 12%, and here we have somebody betting on more upside to continue the gamma squeeze rally. They are buying the $6 calls, expiration date February 19th, with expectation that the name would rally an additional 5.5% or more, and they are paying about 65 cents to enter the trade, and bringing the total for the trade to a little over $250,000. Continuing with unusual activities in the options market on Friday, here is a very unusual trade for the ticker TELL, and this is for Tellurian. It is a natural gas producer, and we had some pending news on Friday for this company, and you saw that the stock rallied over 25%, and here is somebody betting on more upside, buying the 2.5 calls, expiration date February 19th, with expectation that the name would rally over 17% by then, and they are paying about 45 cents a piece to enter the trade, and once again bringing the total a little over $250,000. Now, here is a trade where the stock is trading at about $2, and the trader would rather buy call options instead for 45 cents instead of buying the stock for $2. That tells me that this is an amateur trader who saw the pop in the stock and they're trying to ride the wave higher, and they think that they are smart by paying almost a quarter of the stock value in an options trade. The smart way to do it would be buying the stock and then selling upside options. Think like a banker once again. And here is another interesting one for the ticker RIUT. Riot. This is a bet for Bitcoin and all of these crypto exchanges. And you have a bullish bet here for the 32 calls. Expiration date January 22nd, with expectation that the name would rally over 24%, and they are paying about $1.25 to enter this trade, bringing the total to about $1 million. Now, here is the last trade of the day I want you to pay attention to for the ticker ARKK. This is for Tesla witch Cathie Woods, one of her ETFs. And of course, I issued a tweet on Friday saying that I was compiling a list of the top stocks to short in 2021. And then I realized that Cathie Woods made the job a lot easier for me by creating her ETFs, because her ETFs are pretty much a bunch of bags with a lot of bubbles in them. And why not just short Cathie Woods ETFs instead, because she has done a pretty good job in picking the most overvalued garbage names in the stock market. And here you see a trader, and of course we will keep the identity of this trader anonymous. I'm not saying it is me, but it could be. And here's the trade. Buying the 131 puts, expiration date January 29th, with expectation that Tesla witch Cathie Woods ETFR, that is with a double K, will decline over 7.5% by then, and they are paying about $2.45 for this trade, bringing the total to over $1.3 million. And with that, let's move on to the headlines that shaped the day, and starting with macro news. We had a lot of them coming on Friday. Here is the most important and shocking one. U.S. retail sales post surprise monthly drop to cap dismal year. Of course, everybody came with the expectations that retail sales during the holiday season in December will come up very strong. Of course, we made a video on this channel exposing the two geniuses who said that consumers can't wait to splurge during the holiday season, and the other genius who said that consumers will spend more this holiday season and retail sales will come up very strong because people do not need to spend money on cases of champagne and caterers this holiday season, since we're all isolating, and we will spend that money on sweaters instead. Well, they're both wrong, because here is the reality. U.S. consumers cut back on retail spending during the December peak of the holiday season as the country confronted a surge in coronavirus infections. And I know what you're gonna say. Oh, but this is just retail. Everybody's doing online retail instead. Sales online must have been great. Well, you're wrong, because here it is. Retail sales, online sales. It's a little bit of redundancy here. Negative 5.8% in December, the first drop in series in ages. So even online sales went down in December. What does that tell you? Consumers are running out of cash. For those of you who are old subscribers of this channel, remember my psychological breakdown for the consumer behavior during the COVID crisis. And the last stage is exhaustion. Absent of more and more and more stimulus payments, the consumer doesn't have the purchasing power to keep this economy alive. And here it is. U.S. consumer sentiment cooled more than forecasted in January. Here are the details from the University of Michigan survey. Consumer sentiment came at 79.2. The estimate was 79.5. And last month it was 80.7. And perhaps here is the most important take. Consumer sentiment regarding inflation. And here it is. 1 year inflation expectations came at 3%. The estimate was 2.5. What about the 5 to 10 year inflation? That came at 2.7% versus a rating of 2.5 in the previous month. What does that tell you? It tells you that consumers are expecting a spike in inflation coming up very, very soon. And of course, the Fed agrees with that. They know that all of this stimulus and the savings, and of course, the money that the halves part of the economy have made during the pandemic, all of that money has to be unleashed in form of spending, and that will lead to a huge spike in inflation. And of course, the poster boy stock that will benefit from this spike of inflation and consumer spending is TJ Maxx. The problem is that TJ Maxx stock is already trading above its pre-pandemic highs. So we already priced that in the stock market. And we also had some macro data regarding the housing market in New York City. And here it is. New York City apartment tenants are more than $1 billion in debt for missed rent payments during the coronavirus pandemic, according to a new survey. However, things are starting to turn around here with new movers into New York City who are taking advantage of the cheaper leases and all the offers that apartment buildings in New York City are offering right now. So it is a golden opportunity if you're thinking about moving to New York City and you want to lease an apartment there. Manhattan apartment leases almost doubled last month, a sign that sliding rents and landlord freebies are drawing tenants to New York's costliest borough. We also had an update regarding the chips shortage in the automotive industry. And here it is. Automakers around the world are shutting assembly lines because of a global shortage of semiconductors that in some cases has been exacerbated by the Trump administration actions against key Chinese chip factories, industry officials said. And the question is, how would that impact the industrial production rate, the manufacturing, ISM, and auto sales in upcoming months? Because for now, we had a good number for industrial production. We saw an uptick of 1.6% in manufacturing, almost 1% in utilities, and over 6% in mining. We had more details from a survey of economists from the Wall Street Journal, and the probability of recession in the next 12 months has been dropping significantly, and we are now just above 20% probability that we will have a recession in the next 12 months according to these economists. Moving on to some COVID news and updates. We do have a new strain of the virus in Brazil, and of course, we heard the news from different sources and articles that the authorities in Brazil saw rates of reinfection with the virus from this new strain variant. And of course, the problem we could run into here is, what if some of these new strains, the Brazilian strain or the UK strain, the South African strain, can bypass already existing immunity from people who were infected before and from the current vaccines? What if the current vaccines are not effective with new strains? We don't know that yet for certain. And if it is the case, we could see massive crash in the stock market because you're going to have to take out all of the vaccine optimism and price it out of the market. And here is Moderna CEO Stefan Bancel, and he said, quote unquote, "We are going to live with this virus, we think, forever." Moderna CEO Stefan Bancel said during a panel discussion at JP Morgan 2021. And my question is, wait a minute here, Mr. Bancel. I thought that your vaccine was effective. So why do we have to live with this virus forever? Unless, are we going to have more mutations or more strains? Are we going to need different vaccines every year? How deadly are the new mutations and strains are going to be? Because if they continue the same rate, that also means that we will probably have to be under economic lockdown conditions for years, or what Stefan Bancel says, forever. Very concerning situation here, and we are not out of the woods yet. Furthermore, we heard updates from the current vaccines in Norway specifically. We saw some negative side effects here, specifically for very elderly people. We saw about 23 people die in Norway shortly after receiving the vaccine. Now, we're always going to have a certain percentage rate when this is going to happen with any vaccine, but of course, news like this will encourage the vaccine deniers, and that would perhaps derail the current vaccination outlook that we have. The market is already pricing in a reopening post-vaccination this spring or by the summer at the latest. If we do have more delays in achieving the vaccination goals, then that recovery will perhaps take longer than what the market is expecting. And again, you're going to have to price that out of the market. So we are not out of the woods yet when it comes to the COVID-19 situation. The market has already priced in the vaccine optimism, but any bad news could do significant damage to the rally. Moving on to some market sentiment news. Let's start with this piece regarding Bitcoin from UBS. Yes, Bitcoin can actually go to zero and you can lose all your money. UBS is warning newbie crypto investors. Of course, the current mania in Bitcoin is not based on the utility of Bitcoin or the future. It is due to FOMO. If the guy next to me wants to pay more for Bitcoin tomorrow, then I'm willing to buy and sell it to him. And that goes around. There's another guy who wants to buy for a higher price the day after. And of course, the big question comes to where is the end here for the demand? We know, of course, any announcement from the Federal Reserve or the Treasury Department or the SEC regarding more regulations and restrictions for cryptocurrencies, that will pretty much do it, and you will see the demand disappearing into thin air. But as we stand right now, the demand is still there, the FOMO factor is still playing, and I have a question regarding Bitcoin to answer during the conclusion of this video, so stick around for that. Continuing with market sentiment news, and here it is. Yesterday saw second highest call options volume on record, 31.2 million call options traded on Thursday. And of course, they're all buying call options expiring when? The next Friday. What happened on Friday? The market went lower. And of course, market makers burned a huge bulk of that call options volume, went to expire worthless, or we probably have traders losing billions of dollars on Friday alone. This is just a little teaser of what could go wrong in this very crowded mania trades in the market. Remember, you are not a market maker. Retail traders, I know the Robin Hoodiots think that they are market makers by creating the GameStop short squeeze rally, etc. We'll talk about that in a little bit. However, you were only successful because market makers allowed you to create your short covering rally. Market makers have the power, and if they want to bury you alive, they will do it. They gave you a little bit of taste here on Friday. Yet the call options mania has different shades into it. You have some of the retail aspect chasing very high beta names, Tesla, Plug Power, etc. And then you have some of the institutional participation in the call options mania. And I believe this is an example of institutional participation in call buying. Options reveal growing bullish bets on emerging markets, possibly at the expense of big tech. So the smart money part is migrating into emerging markets, and we have witnessed an uptick in activities for the Brazilian ETF, for Asian markets ETFs, from call options buyers. But again, the retail participation in the options mania remain limited to a small basket of names, mostly concentrated in the tech side of the market. And here, they're reading the institutional shifting from big tech to emerging markets in regards to call options buying as perhaps a catalyst that will come at the expense of the performance of big tech stocks, as you see some of the support from call options buying being pulled off from underneath. And here is an illustration of the current mania in the stock market. It is not just call options buying, but it is also piling in to participate in some of the dumbest and riskiest behaviors in the stock market, such as trying to create rallies in bankrupt companies and companies with extremely weak financial positioning because they are investing on the merits of gamma and short squeezes. And this is, of course, what your darling Jerome Powell describes as market functioning. Here's an example of market functioning. Non-profitable tech versus the NASDAQ, LOL. And here it is. Non-profitable companies are outperforming the NASDAQ for the first time in history. And of course, this is the Robin Hoodiots generation of investing. They invest based on a tip they got on TikTok or Reddit, or because of lazy investing behaviors such as, oh, I like Pelotons. Everybody I know likes Pelotons, so I think Peloton is going to the moon, bro. No financial analysis whatsoever, no ratio analysis, no valuation analysis, no technical analysis, all of that. Who needs that? right? This is the Robin Hoodie's video game market, and this is the greatest illustration. Profits. Who needs profits? Profits are for losers. Revenue. Are you kidding me? Revenue? Who needs revenue? You don't need revenue to go to the moon, bro. Welcome to Robin Hoodie at Land, sponsored by the Federal Reserve. And here is more. Firms with weak balance sheets continuing to outperform or to perform better than those with stronger balance sheets. Ratio hooking up along with broader market. And you see again, strong balance sheets. Who needs that? Strong balance sheets, that is the past. You need to think about the future, bro. No profits and no revenue, just empty promises. When did we see this kind of behavior? Last time around, the dot-com bubble. And we're all aware of how that movie ended. And here it is, looking smart. Retail favorite stocks are besting both the pros picks and the S&P 500. 2020 is the year of the dummy. If you're smart, you look dumb. If you've been trading professionally for 50 years, you're the dumbest person in the block. Meanwhile, a 13 years old who asked his mom to sign up for a Robinhood account is beating your ass and outperforming all of these money managers because once again, 2020 was the year of the dumb. You didn't need to think. You just put your blindfold on, buy random stocks from a hat, buy out of the money call options expiring the same week, buy first, ask questions later. Matter of fact, don't ask questions at all. This is the strategy that worked in 2020. And here is more about the mania and how extreme we are getting. Small caps not taking a breather at all. Yet, Russell 2000 relative to the 200-day moving average continuing to surge to all-time highs. And again, this is to you loser technical analysts who keep telling me, oh, the technical analysis matter and you cannot be extended and diverged from the 200 days moving average. Guess what? Me and my Robin Hoodie friends, we did not even care about technical analysis when we made our investment decision, bro. Technical analysis is for losers. On what about the SPAC mania? Here it is, year of the SPAC. Issuance soared to $76 billion in 2020, the highest in record and a massive jump from prior years. This bubble is much worse, much bigger than 1999. But the mania goes on, and why not squeeze every little bit of juice left from dumb money? And here it is. Dating app Bumble has filed for an IPO. And of course, the IPO is priced at about $8 billion. But by the end of the day, the company will probably trade at over $100 billion valuation because Bumble is the future, bro. It's all you need to know to invest these days. IPO mania, SPAC mania, call options mania. Is the picture starting to get clear here or what? But if it is not, here is more. Stock froth boiled after 600 checks. Now $1,400 may be coming. So if you thought you saw the end of this mania, think again. If the additional $1,400 goes to the same income levels it did before, we are highly likely to see additional speculation in stocks, which could continue to inflate an already existing bubble. Peter Cecchini, founder and chief strategist of Alpha Omega Advisors, LLC, said in an interview, if it goes to people with below average incomes, speculation will be less likely. And we all know where the money's gonna go. Call options buying in Tesla, NIO, Palantir, Plug Power, QuantumScape, you know, the usual. Plus, penny stocks. This is only allowed by market makers who are enjoying the show. They continue to buy stocks, they sell you those call options, upside call options after upside call options, and they enjoy the ride higher because they own these stocks. At some point, they're gonna realize it's over. There is no more steamy money coming, so let's collect the cash and dump these stocks on the heads of these zombie retail traders. The balance of power is in the hands of options riders, aka market makers. It is up to them whether to allow this bubble to inflate higher or to pop the bubble and flush out retail participation from the market. The sums would be hitting bank accounts at a time of a full-blown mania in the market. Volume in penny stocks regularly top 40 billion shares a day lately, up sixfold from a year ago. With day traders venturing off exchanges and into the speculative over-the-counter markets, the options market saw the second busiest day ever for bullish equity calls this week. Meanwhile, Goldman Sachs data show that a basket of retail favorite stocks has surged 10% since the end of December, beating both the S&P 500 and returns on hedge fund favorites by more than 9 percentage points. And of course, the Robinhoodians take that as an excuse for a victory lap or beating Wall Street or kicking Wall Street in the ass. You might be outperforming hedge funds, but you morons, what you're doing is making Wall Street even richer with your dumb money. Who do you think own the majority of these stocks that you guys are pushing higher? The difference between you and them, you don't know how to take profit. You think you're going to time the market correctly and get out when the party's over. There's only one side of that equation that knows when the party's going to be over for sure. Market makers. When they decide that it is time to take all your money away and bury you alive, they will do that. And honestly, that is going to be very good for the market, because perhaps we might return to a normal, actually functioning market, not a functioning market according to Jerome Powell. Because Jerome Powell's functioning market looks something like this. Penny stock peddlers piling into Reddit forum prompt rule change. And of course, this is regarding the organized effort and conspiracy by the Robinhoodians on Reddit to create a short covering squeeze in GameStop stock. And of course, this kind of behavior used to be illegal, and it is still illegal according to the SEC. However, we do have a dormant SEC department that has been in a coma for years now. Here it is. Social media platforms and websites such as Reddit have become must-reads for the Wall Street stock set these days. A forum called r/Wall Street Bets, which boasts 1.9 million users, has shown an astonishing ability to move prices. In less than a year, 1 million new users have joined. Now, with penny stocks surging, last month more than 1 trillion shares of tiny off-exchange shares traded. Forums like r/penny stocks, which has 391,000 members, are growing too. According to the rules update posted by the user The Truth, members of the Penny Stock Forum can no longer promote any services, newsletters, or social media unless it is approved by moderators of the forum, known as a subreddit. Before, the forum only banned promotion of paid products. Now, all forms of promotion are banned, including shelling your social media, the post reads. Over the last 30 days, more than 56,000 new users joined r/penny stocks on Reddit, and more than a third of those came in the last 9 days, according to one of the thread's moderators. In late 2020, the subreddit averaged 1,000 new users per day. That's since picked up to as much as 4,600 a day. And again, keep telling me that it is not the Robinhoodians who are moving the market. It is exactly the Robinhoodians who are participating in these very risky and irresponsible behaviors in the stock market. Meanwhile, Wall Streeters, market makers, insiders are watching the show with a lot of joy in their eyes because they know they're getting richer in the process, and they know exactly how to flush out this dumb money participation once they no longer need it. Here is from the Wall Street Journal. GameStop stock soars and social media traders claim victory. Members of Reddit's popular Wall Street Bets forum have been touting the video game retail for weeks. This is the pump and dump, of course. Individual investors who recently piled into GameStop Corporation are taking a victory lap this week after shares of the struggling company doubled in the last 2 days, putting the stock on pace for its best weekly performance on record. For weeks, members of Reddit's popular Wall Street Bets forum have been touting GameStop, encouraging others to scoop up shares of the video game retailer and begin making bullish wagers. Several posts on the forum had noted that short sellers' bearish GameStop bets had been at elevated levels. So somebody spots the high short float, and this is why I keep telling you this channel, do not short stocks with high short floats. It is a recipe for disaster because this could happen. These pumpers go on Reddit and promote GameStop stock day after day after day. Their interest is they already positioned themselves by buying upside call options way out of the money, and they are hoping to create a short squeeze that will push the stock higher. What is a short squeeze? When all of a sudden we see a surge of call options buying for a specific stock, where the person who is selling you the call option has to buy the underlying stock as a hedge. In case the stock rallies higher and higher and higher, they're not obligated to lose money when the options are exercised. So they buy the stock ahead of time as a hedge when they sell you the call options, leading to the underlying name to rally higher and higher. Sometimes that also coincides with a short covering rally. It gets triggered via algos. Somebody panics, decides to cover before the price goes way higher, and that triggers a snowballing effect in terms of short covering. And that becomes a recipe for wild moves to the upside. And those early entrants to the trade have been pumping and pumping on Reddit. Meanwhile, they have bought call options ahead of time. They see their gains exploding higher. And as the stock continues to move higher, more and more FOMO crowd pile in, buying the stock, buying more call options. But at the end of the day, the early entrants to the trade decide to dump, and then they decide to buy more put options to ride the ride to the downside, stabbing the people who helped them pump the stock in the back. This is the jungle market, and there are no rules. Continuing with the article from the Wall Street Journal, short interest, which indicates the interest of investors betting a stock will fall in value, has hovered around 138% of the stock's free float this year. FactSet data shows this makes it the second most shorted company by that metric across the New York Stock Exchange and the Nasdaq, according to Dow Jones market data. That had some Reddit users predicting that the stock might rapidly rise if short sellers had to cover their bets by buying back shares should the stock suddenly increase in value. So you have a combination of option riders being gamma squeezed and buying the stock as a hedge, and short sellers who are covering their shorts by buying the stock. It becomes a prime environment for this wild rally to the upside. It is manufactured. It used to be illegal, not in this market. On Reddit, on Thursday, Wall Street Bets users were celebrating GameStop's gains. Many posted screenshots of big wins from bullish options bets. Several talked about how they would spend their profits. One user posted that the experience demonstrates that the Wall Street Bets firm, quote-unquote, runs the market. And this is the beauty of this. Let them indulge in the game. Let them become more arrogant to take wilder shots and more risky shots in the future. And then you clamp them down, take all their money and flush them in the toilet. This is always has been the story, unfortunately, for retail participation in the stock market. Moving on to corporate specific news. And on Friday, we had some bank earnings, specifically from JP Morgan, Citibank, and Wells Fargo. And all you have to know about that is JP Morgan is the good, Wells Fargo is the ugly. And we will discuss these corporate earnings in details in a separate video. But we're just brushing off the information so you know what happened when you look at the heat map right after this. JP Morgan, fourth quarter earnings. The earnings per share, $3.79 versus $2.62 expected. The revenue came at a little over $30 billion versus an estimate of $28.65 billion. And of course, the take here is the trading revenue, which remains historically elevated even for JP Morgan, coming up at about $4 billion. So if you're wondering where is all of that call options gambling mania and the trading mania, it is going to the pockets of JP Morgan. And of course, don't forget that these banks are criminal organizations, and nobody run a criminal organization better than gangster Jamie Dimon, wrecking the commodities market, stealing from the PPP loans, washing money for the drug cartels. That is just business as usual in JP Morgan. So if you're looking for a criminal organization to invest in, look no further than JP Morgan. In case there is still any confusion what is causing surge in deposits. Here is GPM. QE has driven significant deposit growth in the U.S. banking system. So they have all the tailwinds going for them from the Federal Reserve, and now we are seeing the surge in the 10 years Treasury yield. Trading activities are picking up once again. It's a golden environment for companies like JP Morgan, Goldman Sachs, and Morgan Stanley. Let's contrast that and move to the ugly earnings that we got on Friday from Wells Fargo. Wells Fargo posted worse than expected expenses in the fourth quarter and took charges of more than $1 billion. Wells Fargo revenue for the fourth quarter about $17.93 billion versus an estimate of $18.09 billion. The earnings per share came at 64 cents versus 60 cents year over year. Of course, Wells got hammered during the trading session on Friday. Continuing with corporate-specific news, specifically in the EV market, starting with Tesla. And here it is. Tesla losing ground in Europe should trouble investors, strategist says. Of course, we covered how Tesla got dethroned in the Norwegian market and VW with the Audi e-tron claiming the first spot. But here is more. Saxo Bank head of equity strategy said Tesla's outpacing by Renault, Volkswagen, and Hyundai in Europe in recent months should have shareholders quote-unquote alarmed. November's European vehicle registration figures showed that plug-ins, a combination of pure electric and hybrid vehicles, rose by almost 200% year over year, while total car registrations across the continent were down 14%. In the latest European EV rankings, the Renault Zoe held onto the top spot, closely followed by the VW ID3. According to sales figures from plug-in vehicle market database EV volumes. You think the culties are going to be alarmed that the souffle they invested in is actually not a monopoly and it's just another electric vehicle maker in a very, very competitive market. And this market is about to become even more competitive, meaning margins are going to go lower and market shares are going to shrink. Shall we add another $300 billion to Tesla's valuation based on market shrinkage optimism? I think so. At least the cultists do. But here it is. The Mustang Mach-E and the Volkswagen ID4, which is due in dealership in March, go about 250 miles on full charge, about the same as the cheapest version of Tesla's Model Y, and start at about $43,000 and $40,000. However, there are some potholes for the new Mustang EV, and here it is. Ford reportedly delays some deliveries of its Mustang Mach-E. And of course, the reason is the shortage in chips. Furthermore, we have the Sony EV. Sony has started testing its Vision S electric car on public roads. Meanwhile, Tesla pumpers have no shame whatsoever. And here is the biggest clown on Wall Street, Wedbush Dan Ives. Tesla new 950 stock price target at Wedbush is the highest on Wall Street, but the analysts still won't say buy. Wait a minute, you're upgrading the stock to 950, but you're not gonna buy? Can you get any clownish than you already are, Dan Ives? And of course, amidst the whole EV wars, which will shrink margin and market share, and you will see these stocks contracting significantly. The whole NIO mania and Tesla mania, that is coming to an end. So how do you exploit the EV wars correctly? Go to the source. Again, I call it a Taiwan state of mind, meaning when we saw the chip wars, investing in Taiwan Semiconductor, the ticker TSM, or any semiconductor manufacturing equipment maker such as AMAT and Lam Research have outperformed the rest of the semiconductor names such as AMD, Nvidia, Intel, Qualcomm, etc. because the competition will pressure these companies to lower their prices, therefore shrinking their margins. Meanwhile, a company like Lam Research or Taiwan Semiconductor Manufacturing, they will manufacture the chips either way. They actually benefit during high times of competition and high demand because their business is to manufacture those chips. And the same mentality should be applied to the EV war. Instead of investing in Tesla, NIO, Xpeng, etc., where these companies are going to go into war with each other, shrinking the margins and lowering these stock prices significantly. As a result, Why not invest in the source, specifically in miners who produce cobalt, nickel, lithium, and all the raw materials that go into EV manufacturing? But if you are still interested in chasing the mania, I have some good news for you, because there is a new Canadian company called Lion, and here it is. A Canadian EV maker is eyeing factory space in the US as the company looks to capitalize on the electrified future that President Biden has laid out. And they are specifically targeting school buses. And the thinking here is to get some government contracts to update all of these old school buses into electric vehicles. So perhaps this is going to be a new IPO that the retail crowd is eyeing next. Continuing with automotive news. And this time, we're talking about Toyota. The latest automaker emissions scandal involves Toyota, which has agreed to pay a $180 million fine for violations of the Clean Air Act spanning at least a decade. And we saw all of automotive stocks declining lower significantly on Friday. We also heard some news regarding Exxon when we talk about emissions and pollution. Here is Exxon. Exxon is being investigated by the SEC after a whistleblower complained from an employee alleging the overvaluation of property in the Permian, the Wall Street Journal reports. And you saw shares of Exxon declining significantly on Friday. The name has been rallying hot as of late, and this was a much needed break here for some investors to take chips off the table and for new entrants to join the trade. And here is the last bit of news I got for you today. On Friday, we heard that the US blacklisted Xiaomi, and you see the continuation of the theme with uncertainty regarding Chinese tech names. We saw the pressure against Alibaba, and now Xiaomi is getting blacklisted. Very uncertain and volatile environment.
And Corn Pop was a bad dude.
And let's move on to review the new Biden's stimulus plan and the impacts it will have on the economy and the stock market. Now, let me do a little background for you here. Here is the chart tracking government spending. This is the federal government spending versus the tax revenue. The gap could not be any more extreme. It is the biggest gap ever, and it signals a very large amount of deficit last year, meaning that any politician that tells you taxes are not going to go up, they're lying to you. Whether the Democrats or Republicans, there is no way possible that we're going to print our way out of this one. The budget deficit has become extreme, and the only remedy right now is increasing taxes. I know what you're going to think. Taxes are going to go higher for the wealthy only. You're wrong. Taxes are going to go up for everybody because we're planning even more spending and the budget deficit will reach extreme levels. So you bet 100% that taxes will increase, and it's not going to happen a year from now or 2 years from now. Biden is very well aware that he could lose his majority in the next election. So he has to do it now. And let me refresh your memory about the story of the stock market since last elections. Right after the Trump election, we saw the market rallying higher on the expectations that taxes will be cut. And as soon as we saw the Trump tax cuts, you saw the market rallying significantly higher, pricing in higher multiples for the market. Since less money will be spent on taxes, margins will improve. Bottom lines will improve, top lines will improve, and you have to reprice the valuations higher. And after that, of course, we got overheated. We had a correction. We traded flat. We saw the beginning of the trade war taking place in 2018. And then, of course, we witnessed the tantrum over the Fed's autopilot policy of increasing interest rates, meaning that the market highly depends on fiscal stimulus from the tax cuts and monetary stimulus from the Fed in terms of quantitative easing and rate cuts, not hikes. The market is, once again, say it with me, a cocaine addict. What is the cocaine? Fiscal and monetary stimulus. But of course, on December of that year, the Fed backed off the autopilot policy, and Jerome Powell said that he's going to remain accommodative for as long as possible, etc. And you saw the market rallying higher. And then in mid-2019 in the summer, we saw that the trade war escalated higher and the market traded sideways for a while before we saw the trade deal, quote unquote trade deal. It was a fugazi deal, but it was a deal on paper. It was good enough for the market to put it behind and rally higher. You saw that rally going on and on all the way to 2020. And then we saw the COVID crash, the COVID correction, and right away we saw the golden environment for the stock market right after that, due to the significant increase in the cocaine flow from both the federal government and the Federal Reserve. And looking at this story, what do you think is going to happen when inflation rises higher, pushing treasury rates higher? As a result, what do you think the Fed will have to do at that point? They will have to increase interest rates, taking the monetary cocaine out of the market. I know what you're going to say. They're not thinking about increasing interest rates right now. But at the end of the day, inflation will speak the loudest. And if inflation gets out of hand, the Fed will have no other choice besides doing yield curve control. Now add to that picture the fact that Biden will increase taxes. Now you're taking the fiscal cocaine out of the market. How do you think the market will react? It will suffer withdrawal, and we might not see these elevated prices for a long, long time. Because the truth is, in terms of a PE ratio perspective, for the S&P 500, we are overvalued and stretched to all-time highs. But perhaps corporate earnings have grown since then to justify the uptick in valuation. No, they have not. Corporate earnings have actually collapsed in 2020 and they have not recovered yet. Now keep this background in mind, because the Biden's policy on one hand is good to stimulate the economy, but on one hand is a recipe for disaster in the stock market. And here it is. The economic policy of the new administration pretty much circles in three main points. Number one, bigger stimulus. Number two, higher taxes. And number three, the $15 minimum wage. Now, a bigger stimulus will be very good for the economy. You will see consumer spending surging higher. You will see infrastructure spending surging higher. However, that adds inflationary pressure in the stock market. It causes treasury yields and risk-free assets yields to rise higher, making stock market valuations less attractive, facing a contraction in multiples as a result. So the surge in stimulus will be very good for value names within the industrial sector of the market, financials, retail, travel, materials, home builders, auto manufacturers, and energy. All of these sectors could benefit from a bigger stimulus due to the inflationary pressure. Meanwhile, that same inflationary pressure is not good for big tech stocks, software stocks, all the high growth stocks, in addition to utilities. Now you have to remember that finding value in this market is becoming very difficult by the day, because even the so-called value stocks and the recovery names, the inflationary names, have already surged to high valuations, historically speaking, when you look at their current earnings. So the bigger stimulus could actually act as the final straw that breaks the camel's back, because the market is already very, very bloated. And this is why I say a bigger stimulus is actually bad for the stock market. Moving on to higher taxes. And higher taxes have a mixed impact in the economy. On one hand, taxing corporations and the wealthy a higher rate could derail the pace of the recovery in unemployment, because businesses will have to factor in the increase in taxes, and that would mean less spending on hiring more employees for companies to meet the revenue and earnings expectations from shareholders. But it could also be good for the economy if the increase in taxes is translated into more government projects, infrastructure spending, more money in the hands of consumers. That could be very stimulative for the economy. And of course, it is no-brainer that higher taxes are not good for the stock market. There isn't a single company that would go and say, yeah, higher taxes are actually good for us. Never heard before. Lastly, let's talk about the $15 minimum wage. Now, you could argue, of course, that this is due. The minimum wage has not been increased for years and years and years. Prices are going higher. Meanwhile, the minimum wage remains very low. But regardless of that, there are implications when you raise the minimum wage. When the federal minimum wage rises to 15%, private businesses and public businesses have to compete with that rate, meaning that will add more expenses for companies, specifically in retail, restaurants, and manufacturing. Meanwhile, the extra bump in minimum wages could be good if translated into spending from these minimum wage earners. And the sectors that would benefit from the bump in the minimum wage will be consumer electronics, video games, travel names, because these workers in restaurants and retail stores will use the extra money to spend it in these sectors of the market. But once again, raising the minimum wage to $15 is also inflationary, which will cause an upside pressure for yields and thus making stock market valuations looking very expensive, having to contract lower. All in all, it is a bad factor for stocks. So in conclusion, while the Biden plan could be good for the economy in terms of stimulating spending and perhaps hiring in the initial stages via the inflationary pressure, this policy is not good for the stock market. Are stock market participants listening? No, they're not, because they're too busy indulging in this bubble. Enough said. Moving on to the heat map analysis. Here is the picture from Friday. Right away, you see yields rising higher, the dollar rising higher. On Friday, what happens? Technology and the high multiple names go down in reaction to the spike in treasury yields, and energy, materials, industrials, financials react negatively due to the rise in the US dollar. We saw significant pain for auto manufacturers. Tesla down, Toyota down, Honda down, General Motors down big, and you see even Chinese EVs were punished on Friday. We saw very few exceptions here. The outliers, the outperformers for the day were Facebook, closing the day up over 2%, Palantir, due to the resurge in options volume, closing about 3% in the green. We saw a rebound in T-Mobile and an outperformance from Home Depot in consumer cyclicals. We saw Kroger outperforming on Friday in consumer defensives. We saw the entire real estate and utilities sectors outperforming the market, along with healthcare. Healthcare remains sort of a neutral sector here, regardless of the inflation or the movement in the US dollar. Let's contrast that with the weekly picture of the heat map. And right away you see that the outperformers in the technology sector came specifically from the value names in chips such as Taiwan, Intel, and Micron. We talked about the theme of buy the manufacturers and the raw material providers. This is exactly what you're seeing in the chips market. Taiwan, ASML, AMAT, Lam Research outperforming the rest of the technology sector. We saw significant pain in big tech. Facebook down over 6%, Apple down almost 4%, significant pain in the software names. Meanwhile, the retail favorite names performed differently. We're talking about the recent IPOs such as Airbnb, DoorDash, and some of the momentum names such as Zoom outperforming. And of course, it is a massive week for General Motors, one of the best weeks ever for the name, up over 16%. We saw a negative picture across the board for the week in consumer defensives, basic materials, mixed picture in industrials, and energy. Real estate and utilities were down significantly earlier in the week, but managed to outperform on Friday, and that made the picture mixed for the week. Similar story here with healthcare. You saw the gains in Eli Lilly, Bristol Myers, and Moderna outperforming the rest of the names in the healthcare sector. Likewise, when we look at financials, we saw significant declines on Friday. However, the week overall was very good for regional banks and big banks such as JP Morgan and Bank of America. The biggest losers in financials for the week happened to be the credit card names MasterCard and Visa. MasterCard down over 8.5%. And the reason behind that could be attributed to the new IPO of a firm that competes in an untraditional way with credit cards. Lastly, let's take a look at the heat map for the weekly performance of the ETFs in the market. We saw a bad week for tech overall. You see the triple Qs down over 2%, and the leverage index, the TQQs, down over 6%. Meanwhile, the bearish ETF for the NASDAQ, the SQQs, outperforming, surging about 7% this week alone. The exception in the technology names or semiconductors, and you saw the SOXL. This is the leveraged ETF, the bullish ETF for semiconductors that actually rallied over 5.5%. So there are pockets of green here even within the tech sector. Outperformance from regional banks, the KRE up over 2%. Energy names, bad Friday, but the week overall was very good. You saw the XLE up over 3%, XOP up over 5.5%. Massive week for retail due to the surge of GameStop stock. You saw the XRT rallying over 5.5%. Likewise, another big week for small caps across the board, but you also saw a surge in the VIX. The VIX proxies, the VXX, managed to close over 4.5% in the green, the UVXY closing over 6.5% in the green. Meanwhile, pain across the board for miners, the GDX tracking gold down over 5.5%. So what is the moral of the story here? We're seeing weakness across the market. We're seeing volatility spiking up. However, we have very resilient pockets in the market that remain very strong, notably energy, small caps, and semiconductor names. And the big question is, when are these sectors of the market going to crack? Moving on to the charts analysis, starting with the SPY from a 15 minutes perspective. We saw a gap down this time around. Can you believe it? The mysterious entity forgot to set their alarm on Friday. We flushed down right away and we caught support from where? The level I've identified for you on Thursday, 374. We bounced from it, closing well above the support line. However, all in all, this is a negative development, a bearish development in the SPY. And let it be, of course, from a 15 minutes perspective. Switching to the big picture, let's see the weekly chart for the SPY. What can we learn from here? We closed below last week's highs. This is a negative development. And the question is, when are we going to go down to revisit the trend line, which will coincide to about 10% correction? We've been extended from the trend line since post-elections, and it is about time to have a correction of about 10 to 15%. That will take us all the way back to the trend line, and then the market will evaluate at that point which direction it wants to go. This is still a medium-term outlook. In the short term, we remain bullish. We are still trading at almost all-time highs. We have not broken any significant support yet, so the short-term picture remains bullish. But any further weakening in this upcoming week and beyond will signal that we are heading toward the 10 to 15% correction scenario. And that would not be very outlandish, by the way. Illustrated here when we move on to the continuous contract daily chart. Been trading in this channel for a while. We have broken above it. And during the video I produced last weekend, I told you that usually when we break above very significant levels of resistance, just like we did in the continuous contract chart, you usually go down to recheck that level for support. The scenario for a 10 to 15% correction is still on the table, but for now, we're waiting for that bounce from the support line, and that would be the bullish scenario. The bullish scenario says we're going to recheck the upper limit of the channel as support. We're going to bounce higher. That would be a very, very bullish signal to buy the market, to go long the SPY. However, the bears are crossing their fingers that retest will produce a failure and we will go down to the support line of 3600 and then pierce below it, opening and paving the way for the 10 to 15% correction scenario. So this is what we're keeping our eyes on this upcoming week. The support of the upper line of the channel and the 3600 level. Moving on to the Qs, 15 minutes perspective. What do we see here? The Qs did not gap down, but also participated right away in the negative activities upon the opening bell, struggling to recapture the trend line, now trading well below it, but still above the support line of 308.5. That would be the next stop to look forward to. Perhaps the Qs need to revisit the support line, gather some energy and momentum to rally higher to recapture the trend. But when we zoom out to the daily chart, the picture is starting to look a little negative here. We have a negative divergence in the RSI. We have a negative crossing in the MACD indicator. We had somewhat of a bear flag formation that played out to the downside on Friday, trading below the trend line, and that tells you all in all that we're getting exhausted here. There's a buyer's exhaustion, absent of a new round of stimulus, and we don't know when is that stimulus is going to hit the market. The new round of stimulus, the $1,400, we have no clue about the timing. So for now, without further stimulus, without overnight pumping from the mysterious entity, it becomes very difficult to maintain this rally. Moving on to small caps, the IWM 15 minutes perspective. We saw significant weakness here on Friday. The IWM gapping lower. Can you imagine that? However, capturing support from where? The upper limit of the channel that we have been tracking for weeks now. You think I'm drawing these lines on the charts randomly? Think again. Let's zoom out to the daily chart of the IWM and what are we looking for this upcoming week? We are looking at the RSI indicator from a daily perspective. You have an upper trend, very defined. We're looking for the breakage of that trend, signaling the loss of momentum once and for all. That would take the IWM to the level of 191.5 at least. So we are watching for a reversal here in small caps. What about the dollar index? And remember, once again, we've been talking about an upcoming short covering rally in the dollar index when everybody was pretty much betting against the US dollar, calling me crazy for predicting that we will see a short covering rally in the US dollar. We're seeing it right now. And on Friday, the bull flag formation played out, breaking above the resistance level of 90.5, signaling that there is more juice for the US dollar to rally. However, that would depend on the calculations of the new Biden stimulus plan. More spending will add more pressure on the US dollar. We have new statements from Janet Yellen saying that the Federal Reserve for now is not gonna tip the scale when it comes to the US dollar. It will let the free market dictate the direction of where the Dixie is going next. We all know that the direction is for the longer term to the downside, not the upside. But we have to watch out where will this short covering rally take us next. Moving on to gold. And of course, gold bulls don't like it when I say that gold will continue to decline. But my job is to present the analysis for you from a partial perspective. When I see a short squeeze rally in the US dollar taking place, you cannot be bullish on the trajectory of gold. This is in the short term, of course. In the long term, gold has a lot of tailwind behind it in terms of higher inflation and the long-term trajectory for the US dollar to decline. But for now, we're looking for the bear flag formation in gold to play out and take us all the way down to the level of 1800, and then we're going to reassess. What about yields? The TNX, you see yields surging very high since the beginning of the year. No stopping sign here. We are looking for an ABC pattern that will take us down to revisit the 1% support and then blasting higher once again. We will see if that's going to play out during this upcoming week or not. Again, an easing in the rally in treasury yields will be good for technology names. So if you see the TNX declining this upcoming week, you know that tech names, software names will outperform this upcoming week. I'm not saying this is going to be the case, but this is what you have to look forward to. The TNX chart remain very important. The dollar index and the TNX, two most important charts in the market right now. Moving on to the VIX, what do we see here? Another attempt to break above the very important resistance level of 25 and yet another failure. However, all in all, the VIX still closed in the green. It is building energy to break once and for all above the resistance level of 25 and the consolidation wedge. The break could happen either way, up or down. My bet is we're gonna break to the upside. Moving on to Apple. What do we see here from a daily perspective? A significant loss of momentum. We talked about watching the RSI. That was your signal right away that the Apple rally is running out of steam. We are making a bearish flag formation that should take us down all the way to the level of 120. So this is what we're looking forward for Apple. Is it going to consolidate at this level, building energy, perhaps newcomers to push it higher, or is it going to be a retreat to the level of 120? You know exactly what would determine that. The chart of the TNX. And by the way, if the double top of 138 persists, that will be the double top of a generation here in Apple's stock. Moving on to Tesla, the last chart of the day. What do we see here? We've been talking about the reversal from the RSI level of 84, the bear flag formation that should take us down to where? To revisit the upper limit of the channel from which we had the big breakout. That's a very typical behavior, by the way, when you see a breakout like this. We discussed it in the SPY, the continuous contract. This is no different story here for Tesla. It is not abnormal for the name to go down all the way to the 700 level to retest that upper trend line of the channel, and perhaps then, if there is enough support, bouncing higher. My bet is that we are not going to bounce higher, and in fact, we're going to go down to revisit the very important support level of 599. Tesla has upcoming earnings, so watch out for the volatility in this name. And lastly, let's move on to conclude this video with answering some viewers' questions. The first question in summary says, is the 40,000 level in Bitcoin a top? The answer is, Bitcoin might have had some volatile movements the last few weeks, but the momentum and the FOMO is still intact. What you hear online and among crypto traders and investors is the anticipation of the 50,000 level. The 50,000 level become a very important psychological level to reach first. And when that is the case, you usually go very close to that level and then pull back downward. And that becomes the top. For now, we are trading in a wedge. The break could happen anyways. Up or down, we're losing momentum here in Bitcoin, but the FOMO is still intact and there is an appetite for risk in Bitcoin, and that could indeed take us to the level 50,000. Let's answer the second question. Do you like any Canadian stocks? Yes, I do, but I will be limited here to the inflationary trade. I'm not interested in buying Shopify and all these tech names. We're going into an inflationary environment, so I'm looking for energy names, I'm looking for financials and metals. And here are some ideas. Idea number one, CNQ, Canadian Natural Resources. And the reason why I'm picking this name over other Canadian energy names is the fact that I'm looking for a company with more diverse production that is not limited to North America. You want to avoid pipeline companies, shale oil, and sand explorations because the new Biden administration will likely restrict the domestic production, specifically regarding fracking and more pipelines. If I have to buy a Canadian energy name, it will be Canadian Natural Resources because they have operations overseas, specifically in Africa, and they will not be limited to North American production. Idea number two, Franco-Nevada, and here is the chart. You see the head and shoulder formation, so we are waiting for a dip here before we enter this name. And the reason is Franco-Nevada is sort of like the Taiwan Semi for gold miners. It is a company that finances the exploration of new mines. So if we see a mining war and everybody rushing for mine exploration, this is a company that will benefit regardless. You will see pressure on Barrick's Gold and other pure miners. But a name like Franco-Nevada could benefit from any acceleration of mining activities due to the inflationary pressure on the economy. Here's another one in materials, and it is the same formation, head and shoulder. We're waiting for a pullback before we enter the name. We do have a big EV war going on between Tesla, NIO, VW, etc. Wheaton Precious Metals is a company that produces a lot of cobalt, nickel, and other raw materials that go into the production of EVs. So this is a company that will win either way, even if we see a very heated competition in the EV sector, pressuring margins for Tesla, NIO, Toyota, etc., General Motors. Wheaton Precious Metals will be a benefactor of that competition because they produce the raw materials. It's another way to apply the Taiwan Semi analogy. Here's another name. We need financials. Banks benefit when we see inflationary pressure in the economy and a rise in yields. You can pick any bank you want, the Royal Bank of Canada, Toronto Dominion. My name is the Bank of Nova Scotia. There is a reason for that. The Royal Bank has a lot of operations tied to corporate financing, investing, and trading activities. We're looking for a name that will benefit purely from the inflationary pressure. When you talk about Toronto Dominion, it is engaged more in the commercial side of direct financing to customers. Again, a good name. However, my name is the Bank of Nova Scotia because they are tied to a lot of treasury positions. In addition, they have more room to run from a technical perspective, and the dividend is still intact for the name. Here is another name to bank on the surge of auto manufacturing and the EV mania. Magna International. Now, this name has ran really hot, pretty much a vertical move since the March bottom. I predict that we will see a softness in auto manufacturing due to the pressure from the chips shortage, and that would pull back all of these stocks down. Tesla, General Motors, etc. The names that ran really hot due to the EV mania. And likewise, you will see a name like Magna that is very involved in auto manufacturing pulling down. that would be an opportunity to buy. This is a weekly chart. Look at where the chart is extended from the 20 weeks moving average. I am looking for more than 10% correction in this name before I consider opening a position. But it is a top pick in the Canadian names. And here are two bonus names I'll throw at you. Speculative ones. Number 1, Dye & Durham, the ticker DND. This is a new software company in the real estate market. It is a promising company. And you saw the name rallying high. It surged from $16 all the way now trading at about $43. Again, we're waiting for a pullback, a sell-off, a correction in the market, but this is a promising name. It is still new and it has the potential to penetrate a somewhat uncrowded area in software. Here is the last name for Neolithium, the ticker NLC. This is a weekly chart. You see the name rallying, pretty much a vertical line, benefiting from the EV mania. All of these names are going to come down to earth. That would be an opportunity to buy these names. The raw material names will outperform the actual manufacturers. So this is another Canadian name that I'm keeping in mind. Anyways, thank you for being with me in the ride for this very long video, because that's all I got for you today. I'll talk to you again soon. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.